Okay, today we're diving into, well, one of the most fascinating parallels you'll find in economic history. Seriously.
It really is striking.
We're looking at the U.S. railway boom right after the Civil War.
Mm-hmm.
Think 1865 to 1873, just this mad dash, this frenzy of building.
Right.
And we're putting it side by side with what's happening right now. The AI infrastructure build out, the chips, the data centers, the massive, massive investments.
Yeah, and the script, the economic, and even the psychological script, it's almost identical. It's uncanny across 150 years.
So that's our mission for this deep dive, right?
Yeah.
To dig into the source material and really show you that capital cycle pattern.
Exactly. You see this breakthrough technology, and then this absolute capital frenzy, often driven by fear, honestly.
Fear of missing out.
Totally. Which then leads, almost inevitably, to oversupply, building too much too fast, and then eventually the market has to correct, sometimes pretty harshly.
And we're not just, comparing steel rails to silicon chips, literally.
No. It's about the underlying patterns, these huge infrastructure waves, what drives them.
Yeah.
We want you to see Cornelius Vanderbilt's time not just as history,
but as maybe a blueprint for today.
Yeah.
For Sam Altman's ambition.
Precisely, because these things are driven by how capital behaves. And those patterns, they don't really change much. When something feels existential, like you have to be in it.
Rational spending goes out the window.
You got it.
Okay, so let's start with the railroads. Let's really paint a picture of that original frenzy, because the sheer scale, it's just jaw-dropping.
It really was. Between 1865 and 1873, the speed was like nothing anyone had seen before.
The number that stand out is, what was it, 20 miles?
An average of 20 miles of new track laid every single day for 8 years straight.
Just think about that. Every day.
Yeah.
The logistics, the manpower.
Yeah, continuous industrial effort stretching across a continent.
And the sources, they really capture the scene.
Yeah.
You read these accounts from Kansas, 10 trains arriving daily, just packed.
Rails, spikes, food, equipment, everything.
And the people. Thousands of Irish laborers, Chinese workers, side by side, sometimes hanging off cliffs, pushing the line forward.
And their camps were like these temporary cities, right?
Yeah.
Tent cities stretching for miles. Infrastructure, building infrastructure.
But this wasn't just, rugged individuals and private companies doing this alone.
Oh, absolutely not. This was heavily, heavily pushed by the government. It was a federally subsidized boom, make no mistake.
Through things like the Pacific Railroad Act.
Exactly. That meant huge government loans. $16,000 per mile in flatland, up to $48,000 per mile through the mountains. Big money back then.
But the loans weren't even the biggest prize, were they?
No way. The real kicker, the thing that really drove the frenzy, was the land.
The land grant.
Massive land grants. The government basically gave the railroads these huge checkerboards of territory along the routes. Millions of acres.
How much are we talking?
Union Pacific got about 12 million acres. Central Pacific, 9 million. Put that together. It's like the combined size of Massachusetts, Connecticut, and Rhode Island. Just given away.
Wow. Okay, so that explains the incentive.
Yeah.
What about the overall economic impact? How much of the nation's effort went into this?
It's pretty staggering. At the peak of that frenzy, railroad investment hit somewhere between 7% and 10% of the entire U.S. GDP.
7 to 10% on just railroads.
Yeah. Total investment was around $2 billion. Doesn't sound like much now, but back then national income was maybe $9 billion. So $2 billion was over a fifth of the country's total savings pool.
The whole nation was basically betting the farm on railroads.
Pretty much. A full commitment to one single technology.
Okay, so that's the 19th century. Let's pivot. What does the source material tell us about today's equivalent, the AI build-out? If the steam locomotive was the key then.
And then today, it's the AI chip. Specifically, things like NVIDIA's H100 GPU. That's the modern engine.
And these things are beasts, right?
Oh, yeah. 80 billion transistors. For training these big AI models, it's like 9 times faster than the last generation. Sells for what, $30,000 a pop?
And they still can't make them fast enough.
Still shortages.
And these digital engines, they need digital tracks. The giant data centers.
A hyperscaler.
And the spending projections there are just astronomical. Future global capex for AI data centers. What's the figure? $4 trillion over the next 5 years.
4 trillion. And when you hear numbers like that, Sam Altman's supposed $7 trillion plan for an AI chip empire.
Suddenly doesn't sound quite so crazy. It sounds like the target you might need to hit.
It starts to sound like the competitive baseline, yeah.
And just like with the railroads, there's a subsidy angle here too, right?
Yeah.
It's not land grants this time.
It's tax abatements, massive long-term local tax breaks.
Okay, but hold on. Can we really compare, say, Microsoft getting tax breaks for a $3.3 billion data center in Wisconsin to the Union Pacific getting land the size of 3 states? Isn't that a bit of a stretch?
Well, it's not about the literal acreage. It's about the economic function. The sources talk about this as economic turf.
Economic turf.
Yeah, it's government action that drastically lowers the cost of capital for specific players in specific places. It gives them a huge competitive advantage, funded indirectly by the public purse. It's the same mechanism as the Pacific Railroad Act, just using tax policy instead of physical land.
Okay, I see the functional parallel.
Yeah.
Lowering the cost of capital, prioritizing one industry.
Exactly. State aid creating winners.
But there's a key difference that maybe makes today's situation even trickier. Durability. You mentioned this idea of a capital black hole.
Right, because that railroad track laid in 1870. It was good for maybe 30 years.
Okay.
But a top-of-the-line AI GPU today, the sources suggest its effective competitive lifespan is only 3 to 5 years, maybe even less.
3 to 5 years, that's it.
That's it, before it's basically obsolete for the cutting edge. So you have this rapid obsolescence. It means you can't just build your AI system once.
So you have to keep feeding the beast. Constantly. Just pouring capital into that black hole to stay competitive. It's relentless reinvestment.
Which brings us to the mindset, isn't it? Why do very smart people, CEOs, commit to this incredibly high-burn, cyclical spending, even knowing the risks?
It boils down to that must-build bigger mentality. And honestly, it's mostly driven by FOMO, fear of missing out.
Like Vanderbilt himself said about his rival.
If they are all building, I must build bigger.
Yeah. And that panic, that competition, it led to just insane duplication. Like, by 1900, New York City had 3 enormous separate grand train stations, all built by competing lines.
Wasteful.
Totally wasteful. And that desperation, it fueled all sorts of crazy financial games, like Jay Gould.
Ah, Gould, the master manipulator.
Right.
Yeah.
Using watered stock, basically shares with no real assets behind them to fund his expansions, the guy was supposedly manipulating like a dozen railway company stocks in a single day.
Speed and domination over stability.
That was the game. It wasn't about sensible return on investment in the short term.
And we hear echoes of that exact same fear, that same sort of prisoner's dilemma from tech leaders today.
Oh, absolutely. The sources are quite explicit. You have Microsoft's CEO, Satya Nadella, apparently admitting privately they might be overinvesting by maybe $200 billion. But then you hear Mark Zuckerberg on an earnings call basically saying, look, maybe we'll misuse hundreds of billions, and that would be bad, but missing the AI era is the higher risk.
Missing out is worse than blowing the budget.
That's the calculus they're making.
And history isn't kind to that approach, generally speaking, that whole grow assets fastest strategy.
It's usually a loser's game long term. The data's pretty clear. If you look back since 1963, the companies with the fastest asset growth, they've historically underperformed their more cautious peers by a huge margin, like 8.4 percentage points a year.
Wow. So the winners aren't usually the ones who spent the most, the fastest.
Rarely. Building the biggest, fastest hole doesn't mean you end up with the gold.
Which leads us, inevitably, to the turn. The point where the market wakes up and realizes, uh-oh, we built way too much. What did that look like back in the 1870s?
It looked like empty trains, seriously. By early 1873, estimates suggest the U.S. rail network was running with over 30% idle capacity.
30%. Just sitting there.
Yep. You had reporters talking about 3 parallel railway lines in Kansas, all fighting over the same tiny trickle of freight, or, anecdotes about trains running daily to some ghost town in Minnesota with almost no one on board.
The tracks were there, but the business wasn't.
Not yet. The economic activity just hadn't caught up to the infrastructure build-out.
And then the financials start to crack. Price wars.
Brutal price wars. Freight rates just collapsed. They fell something like 40% between 1870 and 1875. Went from maybe 2.5 cents per ton mile down to 1.5 cents.
The utilization drops, prices crater.
And shareholder returns. They went from this hoped-for 15% down to under 5%. The economics just fell apart.
And the final trigger, the big one, was the panic of 1873. Started with a bank failure.
Yeah, the failure of Jay Cooke's bank. He was the main financier for the Northern Pacific Railroad. He just couldn't sell any more railroad bonds. The money spigot turned off.
And the whole system seized up?
Completely. The New York Stock Exchange actually closed for 10 days. Think about that. Eventually, 89 railway companies went bankrupt, and the U.S. economy plunged into what they called the Great Depression, a 65-month-long downturn.
Okay, so if history is rhyming, not repeating exactly, but rhyming, what are the warning signs you, the listener, should be looking for today in the AI space?
Based on that historical script, we'd watch for three main things. One, that really high capex to GDP ratio. We're arguably already there, or close.
Okay.
Two, watch for rapidly rising debt levels across the tech sector. Leverage, just like the railroad builders got overextended.
And three,
critically, watch data center utilization rates. Are they starting to dip? And are we seeing increasing price competition for AI services? When those digital tracks start running empty and the providers start cutting prices to fill them, that's when the cycle likely begins its downward turn.
Right. But here's the fascinating part, the paradox, right? Even when the builders go bust or face this massive, painful restructuring,
the infrastructure itself changes everything. The bust actually unlocks the potential.
how so with the railroads?
Well, after the crash and consolidation, the rail network became incredibly efficient. Costs plummeted. Shipping wheat from Kansas to New York, it went from maybe 50 cents a bushel down to 10 cents.
Wow.
And the sources estimate that the efficiency gains from the railroads boosted overall U.S. manufacturing productivity by something like 25%. Huge impact.
So the real winners weren't necessarily the Vanderbilts or the Golds in the long run.
Often not. The big long-term success stories came from the users of the infrastructure.
People like Philip Armour.
Exactly. Armour didn't build railroads. But he saw the potential. He used the new refrigerated rail cars on that national network someone else had built, and boom, he creates the modern meatpacking industry in the 1880s.
Or Sears, using the mail service enabled by the rails.
Right. Using that vast network to become the mail order giant. They reaped the rewards without taking the initial massive capital risk of building the track itself.
There's actually a theory about this, right? This value transfer.
Yeah, you can think of it in roughly three phases. Phase one, which is where we've mostly been with AI recently, value concentrates in the equipment supplier.
The shovel sellers.
Steel mills back then.
Chip makers like NVIDIA today. Exactly.
Okay, phase two.
Phase two, the value starts shifting to the efficient operators. After the bust and consolidation, you had these massive, efficient railway systems emerge. Today, think the big cloud providers, Microsoft, Google, Amazon, the ones running the hyperscale data centers efficiently.
And the ultimate goal, phase three.
Phase three is where the value really spreads out. It diffuses to the applicators and the users, the businesses that leverage the AI infrastructure without having had to build it.
And we're starting to see glimpses of that now? We are. Companies like Siemens using AI in their supply chains, cutting inventory costs by, say, 18%. Or drug companies like Merck using AI to speed up discovery from years potentially down to months.
They get the benefit because someone else built the expensive, risky railroad track.
That's the historical pattern.
So wrapping this up, what's the big takeaway for you listening right now? The technology obviously changes steam whistles to humming data centers.
But the underlying logic, the capital flows, the human psychology, the fear, the greed, the hype, that seems remarkably consistent.
Supply rushes in, driven by that hype and fear.
It overshoots demand, almost always.
And then comes the adjustment, the correction. It's necessary.
It seems to be. Look, the railroad network, it didn't hit its full, stable, transformative potential until maybe 1900. That's decades after the initial boom and bust. But after the restructuring, costs were way down, efficiency way up. The chaos was sort of the price of admission for building that foundation.
So we know AI is going to be huge. It will reshape things just like the railroads did. That's not really the debate.
The real question we should probably leave you with is this. If we accept this capital cycle, this pattern of boom, oversupply, bust, and then eventual integration, how long will that period of adjustment last for AI? How long until we get past the frenzy and the correction and unlock the stable, truly widespread benefits of this incredible new infrastructure?